Think about the last time you paid for a coffee with a $10 bill. That transaction was simple, traceable, and legitimate. Now, imagine that $10 bill, but multiplied by 10 million, and every single dollar of it was earned through a violent crime, corruption, or drug trafficking. It's cash, it's physical, and it's incredibly dangerous for the criminal who has it. They can just deposit 10 million in small bills into a bank without setting off every alarm imaginable. They can't buy a yacht, a penthouse, or even a luxury car with stacks of 20s. So, what do? They run it through a financial car wash. They transform the identity of that money, obscuring its origin so it looks as clean and innocent as the money you used for your coffee. This isn't just a plot point in a movie, it's a massive, global industry that undermines economies, fuels violence, and corrupts institutions. Today, we're pulling back the curtain on the exact, step-by-step process of how money laundering works. More importantly, I'm going to give you a practical lens, the specific, often subtle red flags so you can understand how to spot it. This knowledge isn't just for bankers or cops, it's for any business owner, professional, or financially savvy individual who wants to protect themselves and understand the hidden currents in the financial world. The entire process is built on a deceptively simple three-stage model of placement, layering, and integration. Think of it as a funnel. You start with a huge, dirty pile of cash at the top. And through a series of complex steps, you end up with a neat, legitimate-looking stream of clean money at the bottom. The first stage, placement, is the single most dangerous moment for the criminal. This is the physical act of getting the illicit cash into the financial system. They can't walk into a bank with duffel bags, so they have to be clever. One of the most common methods is called smurfing or structuring. This involves breaking down the large lump sum into many smaller deposits that fall just below the mandatory reporting thresholds, often $10,000 in places like the US. They'll use a network of people, called Smurfs, to make these deposits across multiple accounts at multiple banks, sometimes even in different cities. It's labor-intensive and risky, but it's a classic technique. Other placement avenues include cash-intensive businesses. Imagine a criminal buys a legitimate-looking laundromat, car wash, or strip club. These businesses naturally have high, unpredictable cash flow. They simply commingle their illicit cash with the day's legitimate receipts. At the end of the day, they deposit $15,000, claiming it was all from customers. Maybe only $3,000 was real, the other $12,000 was dirty money, now placed. The key red flag here: a business whose declared revenue wildly outpaces its observable foot traffic or market potential. A tiny pizza place in a quiet suburb reporting millions in annual cash sales is a massive, blinking warning sign. Once the money is in the system, the criminal enters stage 2, layering. This is the complex, international shell game designed to create confusion and distance. The goal here is to sever the audit trail, to make it so convoluted that even the most determined forensic accountant would get a headache. This is where wire transfers, shell companies, and international trade come into play. The money might be wired from the initial bank account to a corporate account in another country. That company, which exists only on paper, then invests it in another shell company in an offshore secrecy jurisdiction. That company might use the funds to purchase overpriced goods, like buying $10,000 worth of printer paper for $1 million in a practice known as trade-based money laundering. The overpayment is then sent back as a legitimate business profit. Cryptocurrency has become a modern layering paradise. Through techniques like chain hopping, where crypto is rapidly exchanged across different, privacy-focused currencies, and through mixing services or tumblers, the origin of funds can be obfuscated digitally before being cashed out again into traditional currency elsewhere. The red flags in the layering stage are all about complexity without a clear business purpose. Multiple rapid-fire transfers between accounts in different countries with no logical commercial reason. Transactions that are just below reporting thresholds but happen with a frequency and pattern that feels deliberate. Companies with no physical address, no employees, and a board of directors who are other shell companies. The entire point of layering is to create a labyrinth, and spotting the entrance to that labyrinth is key. Finally, we reach stage 3, integration. This is the payoff. The money, now thoroughly washed and layered, re-enters the legitimate economy as what appears to be clean wealth. It's integrated. The criminal can now use it openly without, they hope, attracting suspicion. How does this happen? They might have their now clean shell company loan them the money to buy a mansion or a yacht. They might invest it in high-value assets like real estate, art, or luxury watches, assets that can be sold later, with the proceeds appearing as a legitimate capital gain. They might even sell a worthless asset, like a vintage car they own, to a complicit buyer, another shell company, for an exorbitant sum, creating a paper trail of a legitimate sale. In some schemes, they'll invest the clean money back into the very cash-intensive business they used for placement, funding its expansion and further legitimizing their operation. The red flag at the integration stage is often the lifestyle audit. An individual with no visible legitimate income source, no high-paying job, no inherited wealth, who is suddenly purchasing multi-million-dollar properties, funding political campaigns, or making large, charitable donations. The funds appear from a trust or an investment firm based offshore, with documentation that seems just a little too perfect. Now, let's talk about how the system fights back, because that's where you, as an observer, can connect the dots. Banks and financial institutions are the front line. They are legally required to have anti-money laundering (AML) programs. This includes Know Your Customer (KYC) rules, where they must verify the identity of their clients and understand the nature of their business. They use sophisticated transaction monitoring software that flags unusual activity, sudden large deposits into a historically quiet account, rapid movement of funds through multiple jurisdictions in a short time, or transactions with entities in high-risk countries. When a bank sees these red flags, they are required to file a Suspicious Activity Report, or SAR, with financial intelligence units like FinCEN in the United States. The insider secret here is that the criminals know the thresholds. That's why so much activity is deliberately structured to stay just under the $10,000 currency transaction report limit. But the software and analysts aren't just looking at single transactions, they're looking for patterns, the very patterns we've just described. A common mistake aspiring launderers make is underestimating this pattern recognition. They think $9,000 deposits across a week at different branches is clever, but to an algorithm, that's a textbook structuring pattern screaming for attention. So, how can you, as an individual or small business owner, apply this? First, trust your instincts in your own dealings. If a potential client or customer insists on paying large sums in cash for no good reason, be wary. If a new business partner's proposed deal structure is unnecessarily complex, involving rapid movement of funds through multiple entities with thin explanations, pause and do your due diligence. For your personal finances, this knowledge is a shield. Be aware of common frauds that are gateways to laundering, like romance scams or fake investment schemes that pressure you to move money through specific, unusual channels. They might be using you, unknowingly, as a money mule to place or layer their funds. The pro tip for business is simple: know who you're doing business with. A little bit of background checking can reveal if a company is a real, operating entity or just a mailbox in a tax haven. The fight against money laundering isn't just a government problem, it's a collective responsibility that requires an informed public.